Technology is one of the more important industries in the world in modern times. I screened the Infotech Semiconductor companies specifically and came up with 248 names. And what's interesting about a sector like this and a subsector, as I'm going to show in this video, you're going to see a lot of similarities between these companies. So you can see that we've got, some very prominent names in here, and I'm going to cover 15 in this video. But what I think will shock you is how much you'll see the industry, how consistently it has performed, and I'm going to try to give you some logic as to why they've performed so closely in tandem. Not all of them, there's always exceptions to every rule. Hello everybody, it's Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, aka Mr. Valuation. And to kind of a continuation of the subscriber request series of sorts, I've been asked to look at a lot of semiconductor stocks here lately. And so I'm going to cover several that I've been actually specifically asked to look. I already covered a couple in in my most previous video, like Skyworks Solutions. But the point I'm going to get at here is that I want to really look at this as the whole industry, because you're going to see some uncanny similarities throughout the stocks in this industry. And I'm going to try to give you some insights into why they're behaving as they do. Because I think part of, understanding your investments is recognizing what industry the companies you're looking at operate in, what the characteristics of that industry are, and then, of course, ultimately it comes down to what the individual characteristics of the specific company you're looking at actually looks like. So let's go ahead and get into the portfolio. Now, what I've got here is I've created a portfolio of 15 companies in the semiconductor industry. I'm also going to do something a little unique here. I'm going to introduce you to the new upgraded release of FastGraphs that we plan to launch in somewhere in the next month or two. And there's a lot of benefits here. So I just wanted to give you, all of you that are subscribers to FastGraphs, kind of a preview into some of the enhancements that we're going to be making with the tool. One of the things about this particular new setup or new design feature that we've added here is it'll become much more mobile friendly than our current version. So that's something that a lot of you like to use iPads and iPhones, of course, and smartphones and mobile devices will find this new version of FastGraphs much more compatible with your technology. So what I'm going to do is kind of give you a quick introduction into some of the features here. First of all, we've moved navigation primarily to the left side here. You can see that there's still some navigation, like the metrics you'll still pick here, external links you'll pick here, portfolios, you'll pick here. So I'm going to go ahead and go into the portfolio section here and bring up the semi portfolio that I created, where I'm covering 15 companies that I believe are very interesting. Many of them are becoming pretty close to fair value. So I'm going to go ahead and bring this portfolio up here. So I've got the semiconductor industry, and I've got 15 companies in this industry, and I'm going to look at them in alphabetic order like I always do, or like I typically do in these videos. And in addition to that, I want you to see the similarities, and I want you to make sure that you get an idea of how to utilize this tool correctly, because I do find that there are some people that I want to be careful that you don't let the tool mislead you by not interpreting the data correctly. So I think that's really the key, because FastGraphs, the Fundamentals Analyzer software tool, is built on the data that's produced, and it's built on calculating that data and organizing that data in ways that are related to things like the growth rate of the company. So let's start with applied materials here. Now, I've got a long-term graph that goes all the way back to 2002, and I want you to notice I'm going to take the price off the graph, the weekly closing prices, and the normal PE ratio off the graph, because I want you to see some of the basic characteristics of these technology companies, or these semiconductor companies. One thing you'll notice, there's a modicum of cyclicality within this industry. The company does grow, the company has grown, but prior to, let's say, the Great Recession, it was very cyclical and growth was actually very flat. So I'm going to go ahead and scroll back here. This is one of the dynamic features. You can see the real cyclicality here, and you actually had no growth when you were looking at the company there. But now I want to bring your attention, as I go ahead and scroll back and bring it out, how much growth there's been since the Great Recession and over the last 10 or 15 years. So I'm going to drop this down to a 10-year graph. And I want you to notice that growth now has averaged about 24.5%. So the key is growth is what drives valuation and what drives market price, etc. So, let me kind of clarify that. So if I put weekly closing prices on the stock, and now you're seeing 13% growth historically, that simply indicates a 15 PE ratio would be kind of fair value. That's an earnings yield, as I often talk about, of 6.5% or 7%. And you can see how consistently the stock has traded. But I also want you to understand the impact of that, because you can see when the company's earnings were not growing very much, the stock price, was up here at $23 a share at its peak. And, years later, it was actually $13 a share. That's because the stock was overvalued. It's important to try to understand what caused that. The stock was overvalued. The PE was almost 61 back in March of 2002. So you can see that here. Now the stock going all the way out here to October of 2012 was only $11 a share. You actually would have had a major negative annualized rate of return to 6.2%. You'd have lost 56% of your money holding this stock for a decade. Now the reason for that was the business didn't perform very well, number one, and for some reason the market, you can see the 2001 recession ending here. That was during the irrational exuberant period of 2000, 2001, where the stock values were really ridiculously high. So the company was fighting poor performance, operating performance, and it was fighting high valuations. But now I'm going to drop this down to a 10-year graph, just get past the Great Recession. And I want you to note all of a sudden we've got 25% growth. Now here, because of the way this valuation tool works, for high growth, we automatically apply the formula PE ratio equal to growth rate. That's the ratio that, if those of you who are familiar with Peter Lynch, know that Peter Lynch is the one that actually brought that up. Now, I find that PE equals growth rate works very well for companies that are growing at 15% or better, but consistency matters as well. Now, here's the rub. This looks like then that Applied Materials, based on this, has become very, very inexpensive. Okay, but the problem is, note the cyclicality. Now, we had some really big years of growth here. 64% and 37%. We had negative 30%, in fiscal year ending in October of 2019. That was just prior to COVID. And then we had some, pretty strong growth for the next couple of years. Actually, for the next 4 years, you could argue. And now growth is expected to level off again. So what you're going to discover here, and this is part of the tool, so this would be what the theoretical fair value would be based on that growth rate. Now, note that the company performed very well here. If you look at it, we got 24.5% rate of return, which is pretty darn close, if you will, to the actual growth rate of the business during this time frame. But here's what I want you to note. What I don't have on here is the market appraisal of the company. In other words, we call that the normal PE ratio. This is the PE ratio that the market most commonly applies to that company. Now, when I do the maximum graph, you can see that the 15 PE ratio becomes very common. When I go ahead and add it, somewhere between 15 and 20 times earnings becomes reality. When I go down to this 10-year graph, what I want you to note is that I'm using a PE here of about 16.68, which is getting close to that 15 PE ratio now. Extend that out to a 13-year graph where I have 16.56% and I got a PE ratio of 16. That's what the market is valuing these semi-cyclical companies like Applied Material. Now, another factor that I want you to notice as I go through these 15 companies, you're going to see a very similar pattern where, once again, earnings, tracked at that 15 to say 20 times earnings multiple, which would be fair value for the companies that are normal, especially given their cyclicality. And then you see this high valuation that primarily was stimulated by some really awesome performance. So, during 2021 up through October, which is their fiscal year end, the company had a 64% year-over-year growth rate over 2020. And, you can see the market really got enamored with that. But the stock now ended up in really unsustainable valuation territory. And now we've had this correction where it's come down. Now, I'm going to switch to forecasting here at the end, but I'm going to go through these 15 companies very quickly. And I want you to note they're not identical, but there's a lot of similarities in the patterns that you're going to see here. So that's Applied Materials, one of the biggest semiconductor equipment manufacturers in the world. So now I'm going to go to Advanced Micro Devices. Once again, you see a very similar situation. You see the very high valuations we had here based on some really strong earnings growth. But then if I shorten the time frame once again, you get this, change. You get this really high growth rate, which is what obviously caused the stock to rise during this period. But now that growth rate, those growth rates are beginning to slow down. Again, we'll look at that in forecasting here in a moment, and the market is reacting to that. But, when you look at it from this point of view, you see high valuations, historically high, that have now begun to correct on advanced micro devices. Here's ASML Holdings. Another one, you see the fact that the market has even valued this at around 25 times earnings, quite a bit. The thing got really crazy overvalued, and you see the valuation coming. Again, shorten the time frame to about a 12-year graph, and you see that it really got crazy overvalued, and now the price is coming into fair value or starting to look like it's approaching a more sane valuation. I don't want to call that fair value. Now, here's one that's a little different, because with Broadcom, symbol AVGO, you had some really tremendous growth the first year and even the second year. So if I shorten the time frame, watch what happens. Growth goes from the 23%, I get down to a 10-year graph, more, current, and we're starting to see the picture change, and the normal PE is around 15 for this company. So, when I'm looking at AVGO, I'm going to focus more on the blue line here, even though they've had good growth with some of these big numbers. But when I start calling out, I still have an 83% number in here giving me the growth. So I take that number out, and all of a sudden now growth is down to 18%. But I still have a couple of big numbers. Take a couple of more years out, and growth has now fallen into 12%. You want to use these different calculations to see what's happening to growth and how it's affecting the company. I would actually classify Broadcom, which I am long on, as moderately overvalued now. It's not a sell for me. It's what I would consider too high to be purchasing right now at these levels. So let's move on. Let's go into Infineon Technologies. Once again, we see the cyclicality back in, the pre-2008 era. We see some pretty good growth. We see some reaction to very strong numbers coming here. And then we see this correction process that has happened here just recently, where we're now starting to move back towards a 15 valuation level, which, might actually make some sense. The next one I'm going to show you here is Intel. Here we've got something a little bit different. Intel is, of course, the biggest, semiconductor manufacturer in the world. They're facing competition from companies like AMD and others. A lot of companies like Amazon and so on are building their own ARM chips. So, Intel's always facing competition, but they're still the 800-pound gorilla in the sector. Now, if I look at Intel here more recently, you're going to see that the growth rate has slowed down quite a bit to about 5%, but we're still maintaining a 15 PE, and we are expecting, a strong down year of over 35% in 2022, and that's obviously affecting the stock price. The question is, how much is it going to grow, going forward? And that's what you'd have to determine. Intel was one of the ones that I was, requested to talk about. The next one is KLA Corporation. Again, I want you to see this pattern of high valuation, the stock price correcting. But keep in mind, the perspective changes when you draw this. But here, once again, you're looking at about a 17 PE ratio, and if I shorten it a little more, now you're looking at a 16 PE ratio. The point is not to say that's the absolute fair value for these companies. The point is to recognize that there are valuation discrepancies. Now, we're back to this 16 PE ratio, which has been very common. Even though the company's grown at 23.5%, the market isn't really giving it credit for that. So that's something that you take into consideration when you're looking at evaluating this company. Lam Research, another classic example. Notice how the long-term graphs of many of these companies look so very similar. But again, once again, if I shorten the time frame, I get a different perspective. But now I'm back down to that 15-ish PE. Notice these numbers are never perfect. It's a range of valuation. It's a level of valuation that makes economic sense. That's how you should be thinking about this, and that's how you should be looking at this. Now, I'm going to go on to Microchip. Microchip, very similar picture, very similar concept. We draw it, down to a 10-year graph, and we once again see, a very similar response. A little different growth rate, little different valuation. Here's Marvell. Marvell has been very cyclical. It's been really growing very strongly in the last several years. I draw this as a 10-year graph. We still have a lot of cyclicality. I should drop this down to like, a 7-year graph. Now I start to get 20% growth. Notice what's happening to the values here because you have different growth rates, and those growth rates are partially explaining why the valuations of these things has changed during these different times, because it's all functionally related to growth. And it really depends on whether you're looking at it long-term perspective or short-term. Here's Nvidia. Nvidia has been one that's been very strong, way overvalued. It's now correcting very strongly. So I think you get the picture. You're seeing a lot of these companies really beginning to correct. STMicroelectronics, Taiwan Semiconductor got really overvalued, went nowhere for a couple of years, and now it's moving back into fair value. And once again, we look, at a company that's growth rate in modern times has changed rather dramatically. Texas Instruments, very similar picture to what we saw with a lot of these other companies. Prices followed the operating results of the companies, and when you get valuation anomalies, they do tend to affect the company. So there you have it. There are the 15 stocks that I'm going to cover many of them I was asked for. Now what I would like to do is switch gears. I want to go to the forecasting graph, because one of the points I tried to make in this video was that as rates of change of earnings growth vary and change, if you get periods of weakness, you get periods of weak stock valuations. If you get periods of real strength, you get periods of strong stock valuations. Now, we've learned an awful lot from looking at the past here, and we see clear evidence. We see clear evidence that the company's operating results are a major factor in determining the long-term movement of the stock price or the long-term returns that you can expect as an investor. And you always adjust that, like I always say, measuring performance without simultaneously measuring valuation is a job half done. So you always want to look at valuation. Now, I didn't look at any of the other metrics here. I didn't look at the cash flows. I didn't look at EBITDA or sales. Those are all other things that, if you were doing research on any of these companies, you would want to take a look deeper. But the key is, if you're going to be looking to the future, I like to start with these forecasting graphs and like to see what the analysts are saying and what's been going on with their estimates. Now, a company like Texas Instruments, the growth rate is expected to slow down to about 4% over the next several years. That means a 15 multiple would probably be fair value for a company growing at that rate. The stock is currently, trading at a blended PE of 19.8. That's too high. Now, I want you also to notice on this new version that most of the information shows up with very little or actually no scrolling really required. You can see all the information and all the data. That's one of the advantages of this new model that we're going to be doing. So there's Texas Instruments. I would consider this one still overvalued. Here's Taiwan Semiconductor, simple TSM. It is now coming into what I would say is real close to fair value, if not already there. Because remember, these numbers are estimates. That would give us double-digit return potential with, a dividend of about 1.67% and hopefully growing, over the next couple of years. So Taiwan Semiconductor is one that looks attractive. STMicroelectronics looks attractive, but note, the growth rates are changing. It's going to expect to have a very strong growth rate this year. That creates this 13% average, but that 40%-ish growth rate is going to be followed by 5 and then followed by 4 if these analysts are correct. Now, you can also notice that the analysts have been increasing their estimates, from 6 months ago, 3 months ago, et cetera. So these are things that you just want to take into consideration when you're looking at these companies. Now, also, if you go and look at the analyst scorecards of these companies, you're going to notice a lot of these companies are very difficult to forecast, okay? So, you really have to do a lot of hard work when you're looking at semiconductors because of the cyclical nature that I brought to your attention. NXP Semiconductors is starting to look attractive. It's potentially, at a 15 PE, giving you double-digit returns for the next couple of years. Now, it doesn't mean these stocks won't drop more, but they have become attractive enough to where I think you can start considering them. That's the point. Nvidia, I don't think is really there yet. I think we still have a long way to go. Growth is going to be expected to be one of the strongest that I've shown you thus far, but the company's valuation is still extremely high with a blended PE of almost 40 and a growth rate of 20. So you're talking about a stock that's overvalued by roughly 100%. And, if I bring it down here, in other words, if I bring it down here to the next quarter estimate, the stock could have a 45% potential drop if it got moved back into fair value. And I'm using a 20 multiple because of the higher growth rate than I would be, some of these others that I've shown you. Marvell Technologies is expected to really have strong growth. It's getting close to coming into the fair value range. This is obviously more of a growth situation, but you might want to start, looking at it and watching it if it gets any weakness. Microchip technology looks like it's in the fair value range, offering an opportunity for 19%, fair value here at these levels. So that's one you might want to take a look at. Lam Research has come into fair value based on what the forecasts are. This is another important message I'm trying to get across. Some of these adjustments you've seen, when you look at these companies historically and see these big adjustments, those adjustments in valuation or in price are really functionally related to what expectations of the future are going to be. And that's something you should always be thinking about. So I'm going to go through it quickly here now. KLA looks like it's become inexpensive, almost starting to give us a slight margin of safety based on the consensus estimates. Intel actually does offer double-digit rates of return. We are expected to have a down year this year, which I think has been a major source of the weakness in the price. But I believe it's getting to the point now where it's starting to be something you might want to look at. If you look at a dividend yield over 3%, a PE ratio under 10, that's probably a decent time to be making a purchase in this extremely high quality, A+ rated, dominant player in the semiconductor industry. Infineon has come into fair value. Growth is expected to slow down into double digits, but still be relatively strong. So you can start taking a closer look at Infineon if you like, if technology is your thing and you want to invest in technology. As I mentioned, AVGO, Broadcom, AVGO symbol is still, in my view, it's close enough to fair value that I'm not selling it because, as I mentioned, I do own it, as I do some of the others I mentioned here that I've covered already. But the point is, it's still a decent stock to hold. It could maintain this high PE ratio. Look at the normal multiple of this company. It's averaged somewhere around 15 times earnings, as far as a normal PE ratio. And, currently trading at a 17.5 PE ratio doesn't make it a frightening, looking company to me now. Going to ASML Technologies, it's coming into fair value based on a 16% growth rate and a 16 PE. Note, when the growth rate is over 15%, the charting program automatically uses the PEG ratio of 1. The P equals growth rate of 16. So this orange line now is a PE ratio of 16.35, but that would indicate that the company is vulnerable to some, further drops if the market was, behaving rationally. Advanced Micro Devices has fallen. It's starting to enter fair value territory, but I consider it still overvalued. Applied Materials has come into fair value and looks reasonably attractive. So, there you have it. There you have the 15 semiconductors. Many of you asked to see a lot of these. These are what I would consider probably the premier company in the industry, although I have left a few out for sure, and I did cover some others in previous videos. But notice the similarity of how these stocks performed in the industry, and notice how their similar valuations and their similar future expectations have resulted in, adjustments to their valuations. Anyway, it's been Chuck Ramos. I hope you enjoyed this one, the semiconductor sector. It's one of the more important sectors in our marketplace right now, with technology being what it is and becoming such an integral part of our life. If you enjoyed this video, give me a like, ring the bell, follow the channel, and you might also want to take a hard look at Fast Graphs, the fundamentals analyzer software tool. I personally wouldn't even think about investing without it. And I hope you found the insights into our new feature. The technology team is working very hard on getting this out. We think these are a lot of improvements here, are things that you've asked as subscribers to FastGraph have asked for. We think you're going to like it when it gets finished. It's going to require a little bit of learning. I'm still learning how to use it myself, but I'm real excited about the opportunity to bring you these new improvements on the FastGraphs Fundamentals Analyzer software tool. Thanks for watching.